$850 billion doesn't sit on a spreadsheet. It sits in the chamber of a financial weapon pointed directly at the throat of the American economy. And this morning, the People's Bank of China just moved their finger to the trigger. This isn't a threat anymore. This is an execution in progress. I am Ken Au. Welcome to the Vault. Today, we expose the silent bond market massacre, and by the end, you'll see why your mortgage rate no longer obeys the Federal Reserve, and what that means for every dollar you own. The headline number is a lie. They tell you China holds $760 billion in U.S. Treasuries. Clean, contained, manageable. But that number deliberately ignores the agency debt, Fannie Mae, Freddie Mac, the mortgage-backed securities sitting in Beijing's vault. Add those in, and the real exposure climbs to $850 billion. That's not a position. That's a nuclear option. That's leverage over the entire American housing market, the banking system, and your ability to finance anything. For 2 decades, this relationship worked. China sold us cheap goods. We paid them in IOUs called Treasury bonds. They recycled those dollars back into our debt market. It kept our interest rates artificially low. It kept their currency competitive. It subsidized the American standard of living. It was the greatest financial arbitrage in history, until it wasn't. The trade war of 2026 broke the cycle. When the U.S. slapped 60% tariffs on Chinese exports, we essentially told Beijing their dollars weren't welcome anymore, so they stopped recycling those dollars into our debt, and they started liquidating. The latest TIC data confirms that China is selling U.S. assets at the fastest pace since 2015. This isn't portfolio rebalancing. This is strategic de-dollarization at the state level. They're dumping paper promises from a hostile government and converting the proceeds into physical gold bars. The People's Bank of China has added to its gold reserves for 28 consecutive months. Record streak. They watched what happened to Russia's reserves in 2022. Frozen, confiscated, weaponized. They're making sure it can't happen to them. But here's the trap nobody's explaining. The problem isn't that China is buying gold. The problem is who isn't buying the bonds they're selling. This is where things stop making sense, and this is where the system starts leaking. The U.S. government runs a $2 trillion annual deficit. That requires constant new debt issuance. Billions of dollars in bonds every single week just to keep the lights on in Washington. This isn't discretionary spending. This is mandatory. Social Security, Medicare, interest on existing debt. The machine can't stop. In the past, China showed up to the auction. They bought a massive chunk without hesitation, reliable, predictable, essential. They were the whale that kept yields stable, the buyer of last resort that prevented panic. Now they're not only absent from the auction, they're actively selling their old bonds into the secondary market. This creates a supply glut. More bonds for sale than buyers willing to absorb them. It's a fire sale happening in slow motion. When supply exceeds demand, bond prices collapse. And in the bond market, when prices fall, yields spike. Interest rates rise immediately, mechanically, inevitably. There's no delay, no grace period. The math is instant. This is why the 10-year Treasury yield is spiking despite inflation cooling. The narrative says inflation is the driver of rates. That's a lie. The market is realizing there's no marginal buyer left to absorb the tsunami of U.S. debt. The buyer base has collapsed. The Federal Reserve? They're doing quantitative tightening. They're selling bonds, not buying them. They're draining liquidity, not adding it. U.S. banks? They're already sitting on $600 billion in unrealized losses. They're not buying more. They can't afford to. Japan? They're struggling to defend their own currency. They've turned into net sellers. They're dumping U.S. debt to support the yen. That leaves the American domestic investor as the only one left to fund the government's spending spree. But to convince an American to buy a 10-year bond, the government has to offer a much higher interest rate, much higher than what foreign buyers demanded. This crowding out effect forces yields higher across the entire curve. Every maturity, every sector, every loan in the economy feels the pressure, and the most direct casualty is the 30-year fixed mortgage rate. The 30-year mortgage tracks the 10-year Treasury yield. When the 10-year hits 6%, mortgages mathematically hit 9%. This is happening right now, in real time, while you're reading this. And it's completely decoupled from the Federal Reserve. The Fed could cut rates tomorrow. They could slash the Fed funds rate to zero. But if China dumps $50 billion in bonds, mortgage rates would still go up. The transmission mechanism is broken. The Fed has lost control. Their monetary policy is irrelevant when debt supply overwhelms demand. We've entered a phase of fiscal dominance. Debt supply matters more than central bank policy. The quantity of bonds being issued and sold eclipses any rate decision the Fed can make, and the Chinese government knows exactly how much pain this causes. They know housing is the primary engine of the U.S. economy. They know it's the primary source of household wealth for the middle class. They know the wealth effect from rising home prices keeps consumer spending alive. By keeping interest rates high through strategic bond sales, they can engineer a recession without firing a single shot. without a trade embargo, without a military confrontation. It's asymmetric financial warfare. And the timing is surgical, precise, calculated. Semiconductor sanctions escalate. Bond sales accelerate. You cut off our chips, we cut off your cheap credit. Tit for tat. Action and reaction. The difference is China can survive without high-end NVIDIA chips for a few years. They'll develop domestic alternatives. They'll steal technology. They'll brute force their way to self-sufficiency. But the U.S. economy cannot survive 9% mortgage rates for a few years without a massive collapse. Housing freezes, construction stops, real estate wealth evaporates, consumer spending collapses. The entire economic model breaks. Commercial real estate is already teetering. Refinancing walls are hitting. A further spike in rates caused by foreign selling would be the final nail. Trillions of dollars in real estate value wiped out by a shift in bond yields, and the U.S. Treasury is powerless to stop it unless they force the Fed to restart the money printer. But if the Fed starts printing money to buy the bonds China is selling, inflation explodes again. We'd be monetizing the debt of a foreign adversary, destroying the dollar in the process. This is the trap Beijing has set. Either suffer a deflationary depression or a hyperinflationary collapse. There's no soft landing when your biggest creditor pulls the plug. The data shows China is using custodians in Belgium and Luxembourg to mask the scale of their selling. The official number is an understatement. They're using every rally in the bond market as an opportunity to unload billions more. This puts a hard ceiling on bond prices. Interest rates have a floor they cannot break through. The days of 3% or 4% mortgages are gone. We're reverting to the historic norm of high capital costs, driven by the lack of foreign subsidies. The exorbitant privilege of the US dollar is eroding trade by trade. If the world no longer wants to hold our debt, we have to pay a massive premium to fund our lifestyle. That premium is paid by you. Higher credit card APRs, higher auto loans, higher mortgages. You're paying the geopolitical risk premium every month, whether you realize it or not. The bond vigilantes have returned, but this time they're state actors with a strategic agenda. They're not selling because they're worried about inflation. They're selling to inflict pain, and the pain is filtering through. Corporations that borrowed cheap money in 2020 are facing refinancing costs 3 times higher. This will lead to a wave of bankruptcies and layoffs the stock market is ignoring. The equity market is betting on the Fed saving the day. But the bond market knows the truth. The Fed is held hostage by the volume of supply coming from the Treasury. With China stepping away, the supply-demand imbalance is becoming mathematically impossible. We're watching a slow-motion train wreck in the plumbing of the global financial system. The reverse repo facility acted as a buffer for liquidity. It held over $2 trillion of excess cash for 2 years. It was the shock absorber that allowed the Treasury to issue debt without breaking markets. As of this month, that cushion has been drained to zero. The easy money that was soaking up government debt is gone forever. Now every dollar the government borrows must come directly from the banking system. This is happening at the exact moment China is dumping $850 billion, mams. Supply shock meets liquidity cliff. Perfect storm for volatility explosion. Without the reverse repo buffer, banking system reserves are scarce. This drives up the cost of overnight funding. Regional banks already struggling to survive high rates are getting squeezed harder. The unrealized losses on bank balance sheets are metastasizing into a solvency crisis. When bond yields rise, driven by Chinese selling, the market value of bonds held by U.S. banks crashes. U.S. banks are sitting on over $600 billion in unrealized losses. These are bonds they bought when rates were low, now worth 30% or 40% less. As long as they don't sell, they can pretend the losses don't exist. But if depositors get scared and start withdrawing money, banks are forced to sell at a loss. This is exactly what happened to Silicon Valley Bank. But now it's happening to the entire system. China's selling pressure forces yields higher. Those unrealized losses grow larger every day. It's a deliberate strategy to weaken the American banking sector by attacking its capital base. Beijing knows the U.S. banking system is the Achilles heel. If the banks are broke, they can't lend. If they can't lend, the economy grinds to a halt. And the Federal Reserve has lost its primary tool for bailing them out without causing inflation. The bank term funding program that saved banks in 2023 has expired. It cannot be easily restarted. This leaves the Fed with a binary choice. Let the banks fail or print trillions to monetize the losses. Both options destroy the dollar's purchasing power. This fragility is being exacerbated by the de-dollarization of global energy trade. For 50 years, the petrodollar system ensured oil was traded exclusively in U.S. dollars. This created permanent structural demand for dollars from every country importing energy. But China, the world's largest oil importer, is now paying for oil in yuan using swap lines with Saudi Arabia. This petro-yuan arrangement bypasses the U.S. financial system entirely. Saudi Arabia is openly accepting currencies other than the dollar for oil exports for the first time in decades. This is a direct attack on the exorbitant privilege that allows the U.S. to run massive deficits without consequence. If the world needs fewer dollars to buy oil, they have less reason to hold U.S. Treasury bonds as reserves. This structural shift aligns perfectly with the tactical selling we're seeing from the PBOC. They're attacking the dollar from both sides: supply side, dumping bonds; demand side, buying oil in yuan. It's a pincer movement designed to end the era of U.S. financial hegemony. The impact is showing up in the term premium of U.S. debt. Investors are demanding higher compensation for the risk of holding long-term bonds. They realize the U.S. government has no credible plan to reduce the deficit or stabilize debt. The only plan is to issue more debt to pay interest on old debt. Classic Ponzi scheme dynamics. And when the biggest foreign investor calls the bluff, the Ponzi begins to unravel. We're seeing failed auctions where the Treasury struggles to find buyers. Primary dealers are forced to step in and buy unwanted bonds, clogging their own balance sheets. This limits their ability to make markets and provide liquidity. It creates a liquidity trap. Difficult to buy or sell large positions without moving the price. In this environment, a sudden geopolitical shock could cause the entire bond market to seize up instantly. If the Treasury market freezes, the global financial system freezes. Treasuries are the collateral for everything. The Fed is acutely aware of this risk. They're talking about slowing the runoff of their balance sheet. They're terrified the bond market is on the verge of breaking due to lack of buyers. But slowing the runoff is a band-aid on a gunshot wound. It doesn't solve the fundamental problem. The U.S. government spends too much money and relies on enemies to lend it to them. Now that the enemies have stopped lending, the spending must be financed by inflation. This means the price of everything you buy, food, gas, insurance, must go up to pay for the government's debt. It's a stealth tax levied on every holder of U.S. dollars. The Chinese government is forcing the U.S. to choose between hyperinflation and depression. They're betting American politicians will always choose inflation to avoid short-term pain. History tells us that's a safe bet, so we should expect the Federal Reserve to eventually pivot and start printing money aggressively. They'll call it yield curve control or market functioning support. But it's just money printing. This will temporarily save the bond market and the banks. But it will destroy the currency. We're looking at a future where the dollar loses value at an accelerating rate against real assets. This is why we're seeing a crack-up boom in things that can't be printed. The stock market rises in nominal terms, not because companies are more profitable, but because the dollar is worth less. It's the Venezuela dynamic applied to the world's largest equity market. Investors are fleeing cash and moving into anything that will hold value against the coming devaluation. But the safe asset of the last 40 years, the U.S. Treasury bond, is now the source of danger. The 60-40 portfolio is structurally broken. Bonds and stocks are falling together. China has exposed the fragility of the entire Western financial construct by simply stepping away. They've shown the world that the risk-free rate is full of risk. Other nations are taking note. BRICS nations are building an alternative payment system to bypass SWIFT. They're hoarding gold at a rate that suggests they're preparing for a new monetary standard, a standard where trade is settled in hard assets and commodities, not unbacked fiat currency. According to the World Gold Council, central bank gold buying has reached its highest level in over 50 years. They're not buying gold because they like shiny rocks. They're buying it because it's the only neutral asset. In a world of weaponized finance, gold is the only reserve asset that can't be frozen by sanction, the only asset that doesn't have a counterparty who can default. The People's Bank of China has been leading this charge, converting trade surplus into bullion, preparing for a post-dollar world where trade is settled in tangible value. This is Gresham's law. Bad money drives out good money. The bad money is the US dollar being printed to infinity. The good money is gold being hoarded by nations that produce real goods. Pay attention to what central bankers do, not what they say. They tell you gold is a barbarous relic. Trust fiat currency. Yet they're stacking bars in their vaults at a frantic pace. This is the ultimate insider trade. They're front-running the inevitable collapse of the bond market. They know the 60-40 portfolio is dead. For 40 years, bonds were the safe part of your portfolio that protected you when stocks went down. But in an inflationary debt crisis, stocks and bonds fall together. This positive correlation destroys the diversification retirement funds rely on. We saw this in 2022. We'll see it again on a much larger scale as yields spike. Holding U.S. Treasury bonds today is not risk-free return. It's return-free risk. You're accepting a 5% yield on an asset losing 7% purchasing power. That's a guaranteed loss of wealth. So where does capital go when it flees the bond market and the dollar? Hard assets, things that can't be printed by a central bank or debased by a politician. Productive farmland, energy infrastructure, industrial commodities, precious metals. These are the assets that survive currency collapse because they have intrinsic utility in the real world. China is securing these assets globally, buying mines in Africa, farmland in South America, trading depreciating dollars for copper, lithium, oil, arable land, converting paper wealth into real wealth before the music stops. You should look at your own net worth. How much is paper versus real? If your entire wealth is in a bank account and a 401k invested in financialized assets, you're vulnerable. You're the counterparty to the government's debt. You're the one who will take the haircut. Someone knew this pattern, and they positioned for it. The everything bubble was built on cheap credit. The everything bust will be driven by the repricing of that credit. As interest rates settle at a permanently higher plateau, valuations must compress. The price-to-earnings ratios of the S&P 500 can't stay at historic highs when the risk-free rate is 6%. The math doesn't work. The reversion to the mean will be painful. This is why the billionaire exit involves selling tech stocks and buying land and gold. They're moving down the risk pyramid, getting closer to economic reality. They understand that in a fiscal dominance regime, inflation volatility wipes out speculative assets. You need to become your own central bank, holding reserves outside the banking system. Physical possession of assets, not paper claims. If you own paper gold in an ETF, you don't own gold. You own a claim on a bank. In a systemic crisis, that bank may declare force majeure and settle your claim in worthless cash. The distinction between ownership and claims will be the most important lesson of this decade. China is taking physical delivery of everything they buy, leaving nothing in the vaults of London or New York, draining the physical liquidity of COMEX and LBMA, creating a squeeze on the exchanges. This leads to bifurcation: the paper price and the physical price. Soon you won't be able to buy physical gold for the spot price you see on TV. Premiums will explode as scarcity of real metal meets panic of paper holders. We're already seeing this in silver. Physical premiums detached from spot. The market screaming that paper price is a lie and physical supply is tight. This move was prepared. The timing wasn't accidental. China is building a gold Great Wall to protect their economy from coming currency wars. They're not waiting for the Federal Reserve to give them a signal. By the time the Fed admits there's a crisis, capital controls will be in place. They'll try to lock you into the system with digital currencies and bans on cash withdrawals. The central bank digital currency, CBDC, is the ultimate tool for trapping capital in a failing system. It allows them to impose negative interest rates, prevent you from moving money into hard assets. This is the endgame of financial repression necessary to liquidate debt. They need you to stay in the dollar so they can inflate away your savings. If you exit the dollar, you defeat their strategy. But the door is still open today for those who see reality. You can still convert fiat currency into tangible assets without restriction. This window won't stay open forever. The $850 billion sell order is just the first domino. It will topple the bond market, then the stock market, then the currency itself. We're watching the end of the post-war monetary order and the birth of something new. The transition will be chaotic, volatile, destructive for the unprepared. But for those positioned correctly, it's the greatest opportunity of a lifetime. Wealth is never destroyed. It's merely transferred from one set of hands to another, from the oblivious creditor to the prepared owner. You have a choice. Will you be the creditor who gets paid in worthless paper, or the owner who holds assets the world needs? The Chinese government has made its choice. They're moving with speed and conviction, betting against the dollar, betting on the laws of mathematics. Look at the math yourself. Decide if you want to be on the other side of that bet. The time for complacency is over. The storm we've been warning about isn't on the horizon anymore. It's overhead. The rain has started. The shelter of the old financial world is leaking. The bond market is breaking. The dollar system is collapsing. And China just showed you the blueprint. By the time the mainstream admits what's happening, the window will be closed. The metal will be gone. And you'll be standing in line wondering how you missed it. The signal is being sent. Not by conspiracy theorists, by the People's Bank of China, by the bond market, by the mathematics of sovereign debt collapse. You've been warned.